Welcome to Moving Mom and Downsizing Dad, the podcast that prepares you for one of life's toughest yet inevitable moments, stepping in when your parents need you most. Hosted by Chris Spade, a senior real estate specialist with Keller Williams Realty. We'll dive deep into more than just moving. We're talking smart financial planning, making tough decisions with confidence, and strategies to avoid being caught in crisis mode. Join us for real stories, expert insights, and actionable steps to stay ahead of the curve. Now, here's your host, Chris Spade.
Welcome back to another episode of Moving Mom and Downsizing Dad, the podcast where we help Gen Xers navigate life and our aging parents. I'm your host, Chris Spade of Keller Williams Realty San Diego Metro, where I help you specialize in downsizing your parents or show them ways they can age in place and help them make smart financial decisions. Speaking of smart financial decisions, today I'm speaking with Eric Barbarita. He is the managing director and financial advisor at Bangerter Financial Services, specializing in 1031 exchanges and Delaware Statutory Trusts. Now, Eric has a background as a small business owner and consultant. He transitioned into the alternative investment industry after gaining experience at a national advisory firm. Now, Eric holds Series 22, 63, and 65 licenses, enabling him to provide tailored financial strategies that address market trends, risk management, tax implications, and estate planning. Eric is a graduate of California Polytechnic University in San Luis Obispo. He enjoys off-road driving, camping, mountain biking, softball, swimming, and international travel. You're an Eagles fan too, right?
Steelers fan.
Steelers. I knew I was going to get it wrong because our friend Emily told me, and then I was like, wait, I know I'm going to get this wrong.
Philadelphia, right?
Yes.
Not so much a big rival in football, more so in hockey. So
yeah.
No bad blood against the Eagles in football, but.
Oh, okay. Well, good. Eric, welcome to the podcast. Thanks for being here.
Thanks for having me.
Awesome. Well, let's dive right into it. So if you guys listened to Brandon Burns, he talked all about 1031 exchanges, and we're going to transition into Eric, who's going to talk about Delaware Statutory Trust. So Eric, let's expand on what Brandon taught us last week about the power of the 1031 exchange, how it can help save a significant amount of capital gains tax. And explain a little bit about what that was in case nobody caught Brandon's episode, but you're also going to explain how you can actually 1031 exchange your local property into a type of fund that's called a DST, or a Delaware Statutory Trust. So let's kind of unpack a little bit about what Brandon said and then talk a little bit about what a DST is.
Yeah, of course. So if you didn't see last week's episode, remember a 1031 exchange is typically when someone is maybe building their equity or building their real estate investment career, and they're moving up to bigger, better properties or newer properties or adding more doors, and they're selling a property locally, and then they're exchanging that equity into another property by a law that's 1031, IRS code 1031, that's been around for 100 years. And since we're talking about, downsizing dad, moving mom, and simplifying life, some of the people we're talking to today, don't want to go buy another physical local property. They don't want to own another property. So that's what we're going to talk about, DSTs. And before I get into explaining the complicated scenarios, I want to just explain what a DST is, because it's a little weird name. But it's in its core, it's passively investing in commercial real estate. So if you went out and you had $50,000 cash, you could buy into one of these syndications or a LLC or limited partner structure. Those don't qualify for 1031 exchange, but a DST does. So just think about it as passively investing in a commercial property where you still receive the cash flow and income from the tenants in place, and you still have the appreciation potential because you're a part owner of that building. So I'll get right into the next part there as well, is why is it called a Delaware Statutory Trust? It's just a business trust that the IRS created in 2004 for folks that might have most of their retirement savings in their real estate, don't have a 401k, IRA, or retirement plan, and they still get calls from property manager, the roof is leaking, and they want to simplify, but they don't have any option to defer this tax and not have to pay this huge $300,000-$400,000 tax bill. So the IRS said, okay, we'll set up this business trust where the underlying asset is simply a stabilized, high cash flowing, high being relative, but a stable cash flowing property that gives folks this option to kind of set it and forget it. And the nice thing about the DST versus those other structures I mentioned is, again, the IRS blessed this DST as something that you can 1031 exchange into, whereas you couldn't do that with like a limited partnership or an LLC real estate deal. And the nice thing is you remain on title as a beneficial owner in the interest of the trust. So you still have not only the cash flow and the appreciation potential of the building, but you also still receive those tax benefits. That depreciation that you had from your property you sold will still shield some of this new DST rental income from taxes. So in a lot of cases, you're not paying taxes on all the rental income you're receiving from the DST.
That's awesome, because a lot of people, like you had mentioned, they're tired, especially the older we get, right? We want to just have things a lot more simple. And you kind of touched on this a little bit just now, but let's dive into it a little bit deeper. Why might someone want to 1031 exchange into a DST versus a normal 1031 exchange?
Yeah, so like I was saying, normal 1031 exchange is a great solution for a lot of people. But if you kind of understand that you've already created this wealth, and again, as a financial planner, we can look at this holistically as well and say, this individual has enough money and enough equity to live off of, 4 or 5% interest on that equity for the rest of their life. They don't need to necessarily hit a home run anymore because they've already built that wealth. So what is the big benefits of a DST? We'll talk about the estate planning a little later, but the first 3 big ones I think of are no management responsibilities, access to institutional quality real estate assets, and diversification of your real estate holdings. So the first one of those is the big one. No management responsibilities is some people do have an HOA, or they have a property manager, or both. Which are eating into your returns, actually, because they're charging you. Mm-hmm. But the big one is, I think you mentioned it in last week's episode, Chris, the terrible T's of property ownership. And Brandon also kind of mentioned the one thing he learned in real estate was owning real estate really isn't passive. Yep. There's still something you have to do. And even if it's field the call that the roof is leaking, what decision do I have to make now with getting a new roof, fixing the flood issues? So the big one, no management responsibilities, is getting rid of those terrible T's, the toilets, tenants, and trash, and termites, taxes. And then to going off the T's, I think it's poignant to mention, wildfire risk, flood risk. What about what's going on right now with insurance costs going up in certain areas 3-4 times the price? So eliminating those management responsibilities is really the big one. A DST has a cash reserve set aside from the beginning, and that's included in the expected cash flow for the entire maintenance of the entire hold period of a DST, which can last up to 10 years. Most DSTs typically last about 5 to 7, and I'll talk about that a little later as well. But the point is these are operated by institutions that have property managers in place, economies of scale. You're never going to get a call from them. And then moving on to the next benefit, the access to the institutional grade properties. In a traditional 1031 exchange, you might sell your property for $1 million and want to exchange into, sometimes you could do a Chick-fil-A, a triple net property or some other option. But what are you going to get to now in today's, at least in Southern California, with $1 million of any quality?
Not much. I mean, because a single family detached house costs you $1 million.
Maybe right? A parking spot.
You might.
So that's a big one, right? Is you're trying to defer this maybe $200,000 or $500,000 capital gains tax and put that whole million to work into a DST. And we're going to take your million, Chris, that you have in your pocket, and my million that I have in my pocket, and up to 90 or 100 other investors are co-investing into this DST property that could be a $100 million property. So we're buying bigger, better quality properties that as individuals we don't have access to. And also in locations that we wouldn't have access to. So think about like, a downtown Dallas, right? Or downtown Miami, or, all these places go through cycles, but places that are going to be on Main Street and Fifth Street, right?
Right.
Not out, in the rural areas. And then the last advantage, I think, is the diversification. And that comes in 3 subcategories. Diversification across asset class, different real estate asset classes, diversification across tenancy, and diversification across geographical or political climate. So let's dive into each of those. I started to mention, a 1031 is a like-kind exchange.
Right.
But all these DSTs qualify as a like-kind exchange. So another misconception is you sell a single-family rental, you have to go into a single-family rental. Brandon mentioned all this last week as well.
Right.
That's not true. It's just it can't be your primary residence. It can't be the
Correct.
house you live in. So
or a vacation.
It can't be a vacation rental, or it can't be a vacation
home.
Right. So if it's held as rent for a certain amount of weeks of the year, it's 1031 eligible. So you could go into self-storage facility in Phoenix. You could go into, like I said, a AAA, AA quality multifamily high-rise apartment building. You could go into logistics facility, healthcare facility, and that's poignant with our podcast. You can go into a senior care facility. And unfortunately, a lot of those places are really expensive, and they're private pay, and they're always going to have customers as everyone's aging.
Yep.
So we have those DSTs on our platform and portfolio as well. The second is across tenancy. So you might have gone from one renter or maybe a fourplex where you had 4 renters. And if you have gaps in vacancy, even for a few months of the year, or there is a water leak in one of those units, it's detrimental on a percentage basis to your monthly return. Well, if you're going into DST, you can go into multiple DSTs with multiple properties, with hundreds or thousands of tenants that have automatic lease renewal, rent increases every year. That's all already baked in for you. Or in the case of the industrial facilities, the lease could be a large tenant that has a lease in place for 10 or 20 years, which is longer than the DST is even going to be held. And then the third is just transferring your equity into more landlord-friendly states where maybe there's not rent control, more politically friendly environment for owners, and less restrictions, like kind of what we see in California. It's just very difficult to jump through the hoops. So those are the big 3. There's more we'll get into, but I'm sure you have some other questions.
By the way, Eric, quick question. Who qualifies for a DST?
Good question. So only accredited investors qualify for a DST, and that's not any sort of accreditation or experience level. It's just based on income level. So if an individual makes at least $200,000 a year for each of the last 2 years, or a couple filing jointly makes combined $300,000, or if someone has a net worth of at least $1 million or more. So you could be a low income earner, but if you own a rental property in Southern California, it's probably worth $1 million. So that qualifies you as well, or any other assets you hold. So 401k money, jewelry, cars, anything like that counts towards the $1 million net worth, except your primary residence. So your primary residence value doesn't count towards that.
Excellent.
And then we do have some other referral partners we can offer 1031 exchange solutions to, and Brandon Burns as well. If you don't qualify for a DST, that can still help you shield or defer those capital gains taxes.
Awesome. So, Eric, talk to me. Can a property owner sell or defer capital gains tax if they have a mortgage debt on their current property?
Yes, definitely. And I think that's another great advantage of a DST solution. Let's just jump right into an example. Let's say somebody's selling their local property for $1 million and they still have $300,000 mortgage balance and debt on that property, on their rental property. If you want to shield all of the capital gains tax, you have to go buy another $1 million property. But you're only going to come out of escrow with $700,000. So what some people do is they go get a loan for $300,000, and in order to go buy that next $1 million property. So the problem is what? You're getting a loan in today's interest rate environment, right? So that's eating into your returns. And more importantly, if you're older or retired, you might not even qualify for a loan because your income might not be high enough. And it's just a long, really arduous, messy, annoying process.
Yep.
So this really eloquent solution with the DST is you could take that $700,000 in equity and 1031 exchange it into a DST that has 30% loan to value baked onto it already. So on paper, you're absorbing the DST sponsor's debt, and on paper, you end up owning $1 million in real estate because you have a 30% leveraged position. Now, there is a small caveat. The investor's only going to be earning DST cash flow on that $700,000 equity they put in. So keep that in mind. But they wouldn't be paying the interest on if they were going out and get their own $300,000 loan. But the nice thing is they still own $1 million in real estate. So with the appreciation over time, the potential appreciation of the property, that return is going to get a little bit juiced as well. So it's a really great solution in today's climate, I think, with the interest rates.
That is a good point, because some people just don't, like you said, have the wherewithal or the financial means to go get a loan right now. And so this seems just like a big win for a lot of people, quite honestly. Let me ask you this. There's a couple questions that came to mind. Once somebody exchanges into a DST, how long is that for?
Yeah, so in 2004, when they created this DST law, they said that a DST can only last 10 years. So 10 years is the maximum hold time. And the entire investment objective and investment goal is simply to hold the property for cash flow and appreciation, and then return that principal and appreciation back to the investor. So there's no other, value add dynamics or construction or any sort of risky real estate maneuvers. So we don't ever really see them last 10 years. And the reason for that is because there's only so many people going out and buying these large properties. So the owner, the DST sponsor, wants to start marketing the property for sale around year 4 or 5. So what we've seen in trailing average across the industry is about 5 to 7 years, which is how long a DST typically lasts. And through our ongoing relationship with the sponsors and my clients, they kind of say, we think we're going to sell this property in a few months. I call back the client and I say, Mr. or Mrs. Client, get ready, because you're $1 million, not including, let's say, $250,000 in cash flow they've received over the last 5 years. You have another $300,000 in appreciation. So now we have 1.3 that's going to go right back to Brandon Burns or a 1031 exchange accommodator. And it's going to go default back to that exchange accommodator. And now the 1.3 is another 1031 exchange scenario. So now you really have the option to say, I want to take some money out. I want to pay a little bit of taxes, or I want to go back into a real property, Chris, with you, the best realtor in town. Or I want to split it. I want to put some into a real property and I want to put some back into another DST, or just put it all into another new DST that's available at that time. So you're really compounding your interest and earnings that way too, because now you're earning cash flow on that new 1.3.
That's awesome. So you just go right back into it, just like you would any other 1031. You can keep pouring into new ones.
Yeah, and sometimes clients get a little nervous about the illiquidity of a DST, and oftentimes we say to them, you owned your last property for 20 years.
Right.
this one's going to last 5. And a lot of our clients call us up at the end and say, oh, I have to make another decision now. I wish it would have just gone forever.
Yeah. Because you're just getting that check every month, right?
Exactly. Mailbox money.
Mailbox money, those deposits. This is a question I just want to address just to make sure in case someone decides they're not going to work with me or they're listening somewhere else and they can't work with me. A real estate agent cannot help you purchase a DST. You have to have the licenses that you specifically carry, correct?
Right. So financial advisor, in my case, I'm using the Series 22, not the Series 7, but investment advisor license, because a DST, even though it looks like it's real estate, it's a piece of real estate wrapped up as a DST, as a security. So security like a stock or a bond. So you, in some ways, you could think of it as you own shares of that building, like you would own shares of a stock. And, that's why we have to get people's personal financial statements, make sure they're suited for it. Like I said, it's an illiquid investment. But I do help a lot of agents get listings because, like I kind of mentioned earlier, these people that some of the agents are used to doing a 1031 and then getting a commission on the new buy side as well, which is great. But a lot of the people we're talking to today, or might be listening, or their parents, they don't want to own another property, right? Yep. So these are listings that kind of agents can uncover in their network that wouldn't do anything otherwise, or maybe upon death they would sell, but we're helping the agents kind of pull that sale forward till today. Yeah. And on that same note, Chris, I'd like to mention too, if you are an agent out there listening, and or Chris, I know you've done this with your clients that just want to do a regular 1031 exchange, that's fine. And if they can get defensive that I don't want to go into a DST, they might want more growth potential, or it might not be that time in their life yet. Yep. But we really encourage them to still give Chris, you or I, a call beforehand, because lots of times someone's moving their rental property to a new state they're moving to, or back to where their kids live so they could be closer to their rental property. And they're really set on buying another physical property, and they identify one or two on their 1031 exchange sheet. But the third property could be a DST property. Mm-hmm. So if for some reason the inspection on one of those two properties doesn't go well, they get outbid by a cash buyer, or there's simply not a lot of inventory in that specific area fitting their criteria, they can call me up on day 160 or 170 of day 180 and say, all right, I couldn't get one of those two properties. Let's just slide into the DST. It wasn't my first choice, but I'm still going to have my equity growing and cash flowing. And it's just a detrimental hit to someone's net worth to pay that huge tax bill.
Yeah,
so it's a great backup, like kind of insurance option on your traditional 1031 exchange.
Yeah, you made a great point, because inspections can blow up a real estate transaction, and the like we talked with Brandon, there are two clocks going side by side when you're in a 1031 exchange, your identification period and your closing period, and they run simultaneously. So it's always a good idea to just at least have it there just in case as a backup, right?
Right. So yeah, just to clarify what I was saying, you would still have to identify a DST with me during that 45-day window.
Correct. Yes, absolutely. Yes.
But then you would have the 180 days to try to get your two preferred, and then if not, you could slide into the DST.
Yes, absolutely, 100%. What are the fees associated with doing a DST?
Yeah, so the fees are similar to what it would be if you were doing a traditional 1031 exchange and paying the commission on the next property on the buy side. A little bit higher typically than a real estate transaction, because this is just such a eloquent solution for so many people, and it's saving them so much on taxes. And I'm in a highly specialized industry. I don't get paid as much as an attorney or a doctor, but a little bit more than you, Chris, maybe. Now,
maybe
I only get paid on the equity, actually. But the nice thing about the DST is the investor doesn't feel any of those fees. So a DST might have a stated cash flow of 4 or 5%. And if the investor brings $1 million into that DST, $1 million in equity, the projected cash flow is would be, in this example, $50,000 a year divided by 12, paid monthly, and that's net of fees. So they make it really easy to do an apples to apples comparison as to something else you might go into. And in Southern California, we can't get 5% cash flow, right?
No, you can't. You're lucky if you get 2.
Yeah, 0 maybe. So
yeah,
and that's because a lot of these DST properties are not in California. That's one of the reasons.
Yep.
But the investor just doesn't really feel that fee. Another way I like to explain it is, at the end of the example I gave before of a 5-year hold, maybe they've collected $250,000 in cash flow during that 5-year period. And then at the end, the appreciated component is another $300,000. Well, if there were no fees, it might have been like $350,000. So you're kind of paying the fee along the way, but the fees within the fund, that we have economies of scale, so that we can show everyone on our pro formas and on our contracts exactly what they are, and the management fees are like 3.5%. But again, that's already baked in to the stated cash flow of a DST.
Excellent.
So it's a long-winded way of saying the investor doesn't really pay any out-of-pocket cost or expense for fees.
You don't feel it.
Right.
Yeah. Okay. So you've gone over some of the benefits. What are some of the risks associated with the DST?
It's a great question. We like to be upfront about these risks. It's the underlying asset is a piece of real estate. So it goes along with any, same risks you would have owning your existing rental property. One of the main ones might just be that the rental increases don't come as fast as the DST sponsor expected. That being said, the current cash flows typically stay pretty stable, but that might just increase the length of hold period of a DST because they do want to lock in that appreciation. So maybe expect a little longer hold period or not as much appreciation on the back end if they weren't able to raise rents as quickly as they underwrote. Another one is just a general recession along those lines, an economic slowdown. Same type of environment, but you would be exposed to that in your local property as well, right? If we had a recession.
Absolutely.
This is kind of why people like investment real estate, right? I came from the stock world for years, but real estate is typically a cash flowing asset. So, money's still coming in during the slow periods, and then we grow out of them. And usually we have these makeup years where rents go up high or property values go up high. Another big one is, what if there's a big insurance claim? A fire or a flood in one of the units, right? I get that question all the time. Well, these institutional grade properties have millions of dollars of insurance. Oftentimes more than, again, your local property might have, but they also have that umbrella insurance if they're in a flood area or a fire area. And that's why, through my menu of DST properties, we talk about this with the client beforehand and see if they like, this property where it is and what their comfort level is. And I think we already mentioned the fact that it's illiquid. Again, so I can't place someone in a DST if, they're not going to be able to pay their bills and someone that's going to need their money in 2 or 3 years, it's just not suited for them.
Yeah, because you can't just pull out.
Conversation, right. And then the last one isn't so much of a risk, but more of an adjustment for most people I bring this to for the first time is, like I said, these people have owned a property sometimes for 10, 15, 20 years, and it's an adjustment to them. And maybe their first time investing in something passively. Maybe they'd never even owned stocks before. So they got into real estate in the first place because they knew they could drive by and see the renter there and understand that they're getting monthly income. And now I'm selling them this financial product, which is, again, just a piece of real estate, but it's in a different state. So that's why we have brochures. Sometimes we fly clients out if they have a big enough investment, if they want to go actually look at these properties. And in California specifically, we had one downtown. We have one actually in North County that were DST properties. They're closed for investment now, but they're, places you can drive by. So that's a big adjustment for people is it's just something new.
Why should Gen Xers consider a DST for parents that own rental properties, and how can they help simplify the estate planning process?
That's a great question. This is my favorite one for the estate planning process. A lot of other DST reps might have come from the commercial or real estate side of the business. I came from the estate planning side already, retirement plans. But Morgan Stanley, Merrill Lynch, these large firms, if you have a financial advisor there, I'd love to still work with you because they just don't really do real estate or understand it or have any of these solutions on their platform. So now I'm really able to provide this holistic approach to folks' entire net worth, including their investment real estate. So the example I always use is, Brandon mentioned last week that there's that step up in basis. If, let's say, a mother purchased a property for $100,000 and now it's worth $1 million, if she bequeaths that property to her daughter, then the next day the daughter is inheriting it at $1 million and can sell and then owns no additional tax. A DST offers that same step up in basis. While not quite as efficient, most of the tax gets excluded. So if this woman, like we say, we encourage our clients, our elderly senior clients to sell and go into a DST before death. So in this example, Mrs. Jones, she'd be getting her cash flow on her $1 million DST. And in her trust, she writes that her daughter inherits the DST upon her passing. So just like the old house was in the trust, the DST is also now in the trust. And her will and wishes are that her daughter inherit it. So let's say 3 years in, Mrs. Jones passes away. Well, now the daughter is going to just keep receiving that cash flow from the DST. She still can't sell it because the DST sponsor probably isn't going to sell it for 2 or 3 years. And then when they do sell it in 2 or 3 years, there might be a little bit more of a gain, so a slight tax burden if that daughter decides to sell the DST and not do a 1031 exchange. But it would be very nominal. Or again, like we mentioned before, she could 1031 into another physical property locally, or split it up and go some into a real property, some into a DST, or just pay some of the taxes and put it in her bank account. And then the other example with like 3 beneficiaries or 3 heirs really simplifies it. So we see this scenario all the time. Let's say there's 3 properties. So each kid gets 1 property. Well, why did I get this not as good property? Was I not the favorite kid?
Yeah.
So one or all the local properties go into the trust, into the DST before death. And the parent writes that each kid gets a third, a third, a third. So if it's $1.5 million and, 6 years later after the parent is gone, each kid has been receiving the cash flow for a few years, but then they each get $500,000 of the principal and let's say a little bit of appreciation. So each kid gets $650,000 and each kid can go their separate way with that $650,000. So even though the kids might all get along, they have different financial needs at different times.
Yep.
And you see this all the time, Chris. Someone inherits a property and one kid wants to renovate it and try to raise the rents up. The other kid wants to just do nothing and just collect the rent. And the other kid wants to sell it.
Yep.
It's always something different. In this case, the legacy, like that's what we try and impose on the parents is, no offense, but it's the cash flow. It's the equity. It's not physically the property. And even though you might not know about it, you don't necessarily want your kids arguing after you're gone.
Yep. That's we call that blessing your family. Do you want to bless your family or do you want arguments after you're gone? My dad recently told me, he goes, I don't care what happens. You guys can fight about it when I'm gone. I'm like, no. I don't want to deal with that. Even though my brother and I get along very, very well.
Right. And then you can just point to and say, this is what dad wanted. And then there's no argument because he made the decision.
Yep, exactly. So, Eric, in closing, what are some of the last things that you'd like to add?
Yeah, I would just say, I would urge anyone that's considering selling or downsizing or simplifying their life to really take a look at this solution. We're not out here arguing that your investment property in Southern California or certain markets isn't going to continue to increase in value. But remember, if you've already created that wealth, this is about protecting it. The DST is set up as a very conservative wealth preservation vehicle, not a growth vehicle. So this is about buying that time back now. And remember, you're still an owner of one of these properties. So you still have the appreciation potential and component. So you're not getting out of the real estate business. You're just getting out of the actively managing real estate business. And we think a picture's worth 1,000 words as well, like I said. So email us. We can email you some of these brochures. And you can really see how nice some of these properties are. And we also do monthly webinars and local monthly lunches that we invite you to bring the whole family so they can kind of see how this is in picture. And I think you'll put my information down below as well.
Yep.
And I can share my phone number is 619-902-0630. 619-902-0630. And if anyone has a property of at least $500,000 or more, we offer a complimentary portfolio analysis and cash flow analysis of how your property is currently performing and to see if we could help you even increase your cash flow into a DST, which, Chris, we see that scenario all the time in San Diego.
Yep.
People just haven't raised their rents consummate to how much the market values have gone up.
Yeah. Well, because if somebody's got a good tenant, they don't want to raise the rents because they don't want to run the risk of getting a new tenant that's not a good tenant, right? So
that and really vacancy is underestimated as a bigger loss than that's really the largest cost to an owner is that vacancy. So they're trying to find that line of how much can I raise rents without that person wanting to move out.
Yep.
And again, if people are 65, 75 years old, they're not interested in doing $100,000 improvements trying to get those rents up to what they should be.
Yep. Very good point. Eric, thank you so much for being here and explaining this to us. I've been talking to Eric now for probably a good 6 weeks about different things, and I've watched him in a couple different presentations, and every time I speak to him, I learn something new about this. In fact, I really didn't know this was a thing until I had heard about them years ago, but never really invested my time in them to learn about them. And I've learned so much from Eric over the last, 6-8 weeks that this is just something that I think everybody should at least use as an option. Just be open to it, right?
Yeah.
So thank you so much, Eric, for joining us. If you have any questions, I'm going to put all of Eric's contact information down in the show notes so that way you know exactly how you can reach out to him. Or if you just want to reach out to me, I will put the two of you in contact as well. As always, thank you so much for listening, and I look forward to catching you on the next one. Have a great day, everyone. Bye-bye.